The air crackled with anticipation on Wednesday as the Federal Reserve, the nation's central bank, unveiled its latest policy shift. In a move that sent shockwaves through the financial markets, the Fed announced a half percentage point cut to its benchmark interest rate, a bold maneuver aimed at bolstering the U.S. labor market. This decision marks a significant pivot from the Fed's relentless focus on taming inflation, a focus that has defined its actions over the past year and a half. This pivot, however, is not a sudden swerve off the road but rather a carefully calculated adjustment of the steering wheel. The Fed, under the watchful eye of Chairman Jerome Powell, is navigating a complex and increasingly uncertain economic landscape. The days of soaring inflation are receding, but the path to a soft landing, a scenario where inflation is tamed without triggering a recession, remains shrouded in mist. The Fed's decision to lower interest rates reflects a growing acknowledgement that the risks to the economy are no longer solely focused on inflation. The committee, in its statement, declared that the risks to employment and inflation are now roughly balanced, signaling a shift in priorities. The language, though subtle, carries significant weight, underscoring the Fed's intention to prioritize job growth while remaining vigilant about the inflation threat. This delicate balancing act is evident in the division within the committee. A narrow majority of 10 out of 19 officials favored lowering rates by at least another half point over the remaining meetings this year. This suggests a strong desire to provide additional support to the labor market. However, 7 policymakers opted for a more modest quarter-point reduction, highlighting the lingering concerns about potential inflationary pressures. The dissenting vote from Governor Michelle Bowman, the first from a governor since 2005, further underscores the complexity of the situation. While the Fed is leaning towards easing monetary policy, it's crucial to understand that this is not a knee-jerk reaction. The decision is rooted in a careful assessment of the economic data. While inflation has cooled considerably, reaching 2.5%, it remains above the Fed's 2% target. The labor market, while strong, has shown signs of weakness, with job gains slowing and unemployment ticking up to 4.2%. The fear is that a further cooling in the labor market, a development that Powell has described as unwelcome, could trigger a more significant economic downturn. The Fed, in its statement, acknowledged these economic realities, highlighting the somewhat elevated level of inflation and the slowing pace of job gains. The committee emphasized its strong commitment to supporting maximum employment, a clear signal that it is willing to prioritize job growth, even if it means temporarily accepting some level of inflation. The Fed's decision has been met with mixed reactions from the financial markets. The S&P 500 index, a measure of U.S. stock performance, swung between gains and losses in the immediate aftermath of the announcement, reflecting the uncertainty surrounding the Fed's future actions. Treasury 2-year yields, a gauge of short-term interest rates, dipped slightly, suggesting that investors are anticipating further rate cuts in the coming months. The Fed's actions are not just a matter of numbers and economic forecasts. They have a profound impact on the lives of ordinary Americans. Lower interest rates, in theory, should make it easier for businesses to borrow money and invest, leading to job creation and economic growth. However, the flip side of the coin is that lower interest rates can also fuel inflation, eroding the purchasing power of consumers. The Fed's decision to cut interest rates represents a gamble, a calculated risk that the benefits of supporting the labor market will outweigh the potential risks of reigniting inflation. It's a gamble that will be scrutinized by economists, policymakers, and everyday Americans alike. The outcome, however, will not be known for months, perhaps even years. This is a story that is unfolding in real time, a story of economic data, policy decisions, and the lives of millions of Americans. It's a story that requires careful analysis, thoughtful interpretation, and a willingness to acknowledge the complexities of the situation. As we look ahead, the Fed's path forward remains uncertain. The committee is closely monitoring economic data, carefully weighing the risks to inflation and employment. The question is, will the Fed's pivot be enough to ensure a soft landing, or will the dance between inflation and employment lead to a more disruptive outcome? Only time will tell. The Fed's recent decision to cut interest rates, while a headline-grabbing event, is just one chapter in a complex and ongoing narrative. To understand the implications of this pivot, we need to delve deeper, examining the underlying forces shaping the Fed's actions and the potential consequences for the broader economy. The Fed's actions are inextricably linked to the ongoing battle against inflation. While inflation has cooled considerably from its peak in 2022, it remains a significant concern. The Fed's mandate is to ensure price stability, and it is wary of allowing inflation to spiral out of control. However, the Fed's actions must also consider the impact on employment, a vital component of the U.S. economy. The Fed's decision to cut interest rates is a recognition that the risks to inflation are now more manageable. The committee is confident that inflation is heading in the right direction, but it is still watching closely for signs of a resurgence. This cautious approach is reflected in the Fed's decision to lower interest rates by a half percentage point, a significant move, but not a full-fledged easing of monetary policy. The Fed's decision to prioritize employment is driven by the recognition that a healthy labor market is crucial for a strong and sustainable economy. While the labor market has remained resilient, there are signs of strain. Job gains have slowed, and unemployment has ticked up, suggesting that the economy is losing some momentum. The Fed is concerned that further cooling in the labor market could lead to a more significant economic downturn. They fear a scenario where businesses, facing a weakening demand environment, are forced to lay off workers, leading to a domino effect that could ripple through the economy. The Fed's decision to cut interest rates is an attempt to prevent this scenario from unfolding. Lower interest rates should stimulate borrowing and investment, potentially leading to job creation and economic growth. However, this is a delicate balancing act, as lowering interest rates too aggressively could reignite inflation, undermining the Fed's efforts to tame it. The Fed faces a difficult dilemma. On one hand, it needs to ensure price stability, a core principle of its mandate. On the other hand, it must also prioritize job growth, a vital ingredient in a healthy economy. The Fed's recent actions reflect its attempt to navigate this complex and often contradictory landscape. The committee is carefully monitoring economic data, weighing the risks to inflation and employment, and adjusting its policy stance accordingly. The decision to cut interest rates is a response to the current economic landscape, but it's not a one-time event. The Fed will continue to assess the situation, adjusting its policy stance as needed to ensure a soft landing for the U.S. economy. The Fed's actions have far-reaching implications. Lower interest rates can impact everything from consumer spending to business investment to the value of the dollar. It can affect the cost of borrowing for individuals and businesses, the stock market, and even the global economy. The Fed's decision to cut interest rates is not just a technical matter of monetary policy. It's a reflection of the complex and interconnected nature of the U.S. economy and the challenges facing policymakers as they navigate a world of economic uncertainty. The Fed's path forward remains uncertain. The committee is closely monitoring economic data, carefully weighing the risks to inflation and employment. The question is, will the Fed's pivot be enough to ensure a soft landing? Or will the dance between inflation and employment lead to a more disruptive outcome? Only time will tell. The economic landscape is constantly evolving, and the Fed's actions will need to adapt accordingly. This is a story that will continue to unfold, a story of data, decisions, and the lives of millions of Americans. The Fed's actions, while driven by economic data, have a profound impact on the lives of ordinary Americans. Lower interest rates can make it easier for people to buy homes, cars, and other big-ticket items. It can also encourage businesses to expand and hire new workers. However, the Fed's actions can also have negative consequences. Lower interest rates can make it more difficult for savers to earn a return on their investments. It can also lead to higher inflation, eroding the purchasing power of consumers. The Fed's decision to cut interest rates is a balancing act, a delicate dance between competing priorities. It's a decision that will be analyzed by economists, debated by policymakers, and felt by everyday Americans. The Fed's actions have ripple effects far beyond U.S. borders. In an increasingly interconnected global economy, the Fed's policies can impact exchange rates, global trade, and the stability of the international financial system. The Fed's decision to cut interest rates is not just a domestic affair. It's a reminder that economic policies have global implications, and that the Fed must operate with a keen awareness of the interconnected nature of the world economy. The economic landscape is complex and unpredictable. The Fed's actions, while carefully considered, are just one piece of the puzzle. Policymakers, businesses, and individuals must work together to navigate the challenges ahead. The Fed's pivot to prioritize employment is a welcome development, but it's not a magic bullet. It's a sign that the Fed is willing to adapt its policies in response to changing economic conditions, but it's not a guarantee of success. As we move forward, we need to remain vigilant, monitor economic data closely, and engage in constructive dialogue about the best path for the U.S. economy. It's a path that requires collaboration, understanding, and a willingness to adapt. The Fed's decision to cut interest rates is just one chapter in a larger story, a story of economic forces, policy decisions, and the lives of millions of Americans. It's a story that is still being written, a story that will continue to unfold in the months and years to come. The Fed's pivot is a reminder that the economic landscape is constantly evolving and that policymakers must adapt to those changes. It's a story that requires careful analysis, thoughtful interpretation, and a willingness to acknowledge the complexities of the situation. The Fed's recent actions are not just a story of economic data and policy decisions. They are a story of people, of their hopes, their fears, and their dreams for a better future. It's a story that must be told, a story that must be understood. We must not lose sight of the human impact of these decisions. We must remember that economic policy is not just about numbers. It's about people's lives. As we move forward, let us continue to monitor the Fed's actions, engage in constructive dialogue about the economic challenges we face, and strive to create a future where everyone has the opportunity to thrive. The Fed's recent actions are a moment for reflection, a time to consider the challenges we face as a nation and to think about the path forward. It's a time to remember that economic policy is not a spectator sport. It's a story in which we all play a part. Let us work together to create a future where the U.S. economy is strong, sustainable, and inclusive. Let us strive for a future where everyone has the opportunity to achieve their dreams. The Fed's decision to cut interest rates is not just a story of economic data and policy decisions. It's a call to action, a catalyst for change. It's a reminder that we must work together to address the challenges we face, that we must prioritize job growth and economic opportunity for all Americans. Let us seize this moment as an opportunity to build a stronger, more resilient, and more equitable economy for generations to come.